So, Jurrien, what are you telling investors to do this morning?
Look, the markets is grappling with a slowdown in earnings growth. I think the Fed, we kind of know where the Fed's at. You know, the Fed's basically saying if the economy is going to grow 2.3% next year, which is their target, and inflation's at 2%, then we're inclined to hike 2 more times. But there's clearly downside risks to that. We don't really see inflation going north of 2 anytime soon. So I think the Fed did what it was supposed to do. You know, the Fed cannot overreact to every 10% decline. I mean, we're asking Steve, the odds of a 10% decline historically are 1 in 3. So they happen all the time. It's part of the noise factor in the markets. But so at this point, I'm thinking we're going to get 5% earnings growth next year. The Fed is nearly done, maybe not quite done, but nearly done. And the forward P is trading at a 14 handle. I think that's a fairly good value proposition for long-term investors. But you know, when the market faces uncertainty, PE comes down. It gets derated, and that's exactly what's happening.
Do you agree with that, Brian? Are you also telling investors to buy stocks and that earnings are going to go up next year?
Yeah, absolutely. I mean, we actually believe that this cycle is going to last far longer than most investors expect, but we do need clarity that there's not going to be a major policy mistake here. So the market has a right to be concerned with the Fed message yesterday, because in a low inflation world and a slowing growth world, to continue to raise interest rates is inherently deflationary and could end this cycle. Now, that's not our base case. We ultimately believe that the Fed will back down from its tightening stance. But until we get to that point, there'll be some volatility in markets. So, yeah, markets look good from a long-term perspective. Valuations are reasonable. Growth should be okay unless there's a policy mistake. So I would tell investors stay the course, but be mindful if the Fed goes too far with this tightening stance.
Hey, Jurrien, it seems like the reaction to the market, first of all, this market has reacted with selling to almost every potential positive catalyst in the last 3 months. But it seems like the reaction just does show how many other things the market was contending with besides the Fed and wanted the Fed somehow to rescue it from them. What interrupts that process of this market essentially looking on the dark side, being afraid, frankly, that a soft landing is not something that can be engineered as we slow down into 2019?
Yeah, I mean, ultimately the cycle ends for 2 reasons, right? One is that the Fed has to chase inflation and commit basically a policy error. At this point, I think the Fed is telling us that that's very unlikely. The Fed is very open to, you know, kind of taking a more nuanced view and get it going off autopilot. And the other one is, you know, bubbles or excessive leverage in the system. And other than corporate balance sheets, or the government balance sheet for that matter, there really is not the kind of the excessive leverage that we saw in '08. So I don't see either of the 2 ingredients at this point ending this cycle. And we have had soft landings before. It doesn't happen often. We've talked about, you know, 1994 a lot, but it has happened. And usually it's inflation that kills the whole thing because it forces the Fed, it inverts the curve, and we all know what happens next.
Jurrien, I don't think the concern, not to interrupt, but it sounds like what you're saying is the Fed indicated flexibility and therefore they'll react to the data. If they need to pause, they'll pause, and you think they will. I don't think that's the worry today. I think the worry is that they are tightening into what is a sharper slowdown than the Fed is seeing right now, and that could be potentially a lot more damaging to the overall global economy.
So I think the 2 ways that the Fed could commit
too late.
I don't think it's too late. So the Fed is committing a policy error, if it's committing a policy error, which I don't think it is. But if it is, it's because neutral is nowhere near where we think it is. It's not at 2.5 to 3.5, but it's at 1.5 or 2, and the Fed's already overshot. Or that quantitative tightening, as it's called, the balance sheet runoff, is having a far bigger negative impact on liquidity, et cetera, than we think. And, you know, quantitative tightening is it's hard to quantify. Nobody really knows what it means. And so that's where we would have to look to say the Fed's already gone too far. But
let me jump in here with 2 points. So let me jump in here with 2 points.
All right, Brian, go ahead.
Yeah, the first one is we've seen this play out before. We saw the Fed get too tight in 2015 and 2016. What happened? The dollar got strong, oil prices fell, high yield spreads blew out, emerging markets underperformed. The Fed backed down from its tightening stance, the dollar stabilized, oil prices went up, high yield performed better, emerging market and international assets outperformed. I would expect to see that play out in early 2019 as the Fed backs away. The second point I want to make, this idea about excess in corporate balance sheets. I know we hear that in a lot of different places. I want to remind viewers that when you're near the end of a cycle, corporate credit growth tends to be 10, 11, 12% year over year for a long period of time. That's the danger zone. Right now, corporate credit growth year over year is 6.2%. It's about half of the danger zone. So this is not the end of the cycle unless you go too far on monetary policy tightening or too far down this path with a trade war. If not, the dollar moderates and this cycle goes on.
Finally, Jurrien, I mean, if you're bullish, what's going to be the next catalyst? The Fed didn't do it.
I think getting some clarity on earnings growth. So obviously we've had a huge earnings boom this year. Earnings growth is at 24% year over year. The estimates for next year were 12, they're down to 9. If you apply the typical downward drift to estimates, we're probably going to be at 5. But trade plays a role in that. How much will that depress earnings growth further? And it's the juxtaposition of earnings growth and the PE that ultimately matters. So as we get into 2019 and the market gets a sense of where earnings growth will sustainably settle in, then I think the market will have a lot more clarity. And by then, China will have hopefully reflated further. We'll have more clarity on trade. And at that point, again, it's where the PE trades. Where the PE goes is very powerful. If you take 5% earnings growth next year, you get a 7% return plus dividends. If the PE goes up, 10%, all of a sudden you get a 20% return. And so that's really where the variability comes in.